and welcome to Mint. I am Nasrin Sultana. There are warning signs that global recession is around the corner. Is it real recession or is it mere slowdown? Also, global central banks like the US Federal Reserve and ECB are on an easing stance. What does it mean for emerging markets? What does it mean for foreign investors who are exposed to EM funds, specifically India? To understand that, I'm joined by Matt Wacher. He is the CIO of Asia Pacific at Morningstar Investment Management. Matt, what is your outlook on the emerging markets fund right now?
We're valuation-driven investors, and so we've really spent a lot of time analysing the expected cash flows from the market, emerging markets and global markets. But I guess we see emerging markets as a reasonably good opportunity holistically. Now, if we break that down into European and Asian markets first, and leaving aside South American for the moment, we think that there's some very good opportunities in European emerging markets. But leaving that to one side, in Asia, I think that there's some good opportunities in places like Korea. India is probably at this stage, even after the big sell-off that we've seen in Indian equities over the last 15 months, we're seeing it still a little bit overvalued, but it's certainly starting to make its way into our portfolios more holistically.
Right.
Even adding a little bit to smaller mid caps now.
Okay, but we've seen over the few months, foreign investors are kind of reducing their exposure to EM funds with focus to India, of course.
Yes.
India is not into that overweight allocation.
Sure.
Any reason or any risk that foreign investors are finding in EM funds?
We will see that other investors pulling out money and markets selling off as an opportunity to invest at lower valuations. And so hence why we're starting to think about India more holistically in our portfolios, in our global portfolios. Obviously, we think about them a lot in terms of our Indian portfolio.
Okay, so how does EM get positioned in your entire portfolio vis-a-vis the developed markets?
So, well, I guess it's different for each of the regions, but generally the way that we will size positions isn't, in some cases, is benchmark relative, but we're quite unconstrained. And so where there's a benchmark relative position that we're putting on, we're effectively, we have very big ranges around it. So if it's bubbling up as a valuation opportunity, as India is starting to do at the moment, or for example, Korea is a very good opportunity from the emerging markets that we see at the moment from a valuation perspective. If they're starting to bubble up through our investment process, we'll size them. We can take quite large positions in those assets.
Okay.
Probably larger than other more benchmark relative traditional asset managers would.
Right. So during this time, there are a lot of economists and market analysts who have been, indicating and warning signals about the recessions, global recessions. Do you think this is a recession or it's mere slowdown?
So again, we're not macro investors. We're certainly seeing slowdown. We're certainly seeing earnings slow down globally, and that's what we're really focused on. We're focused on, well, if earnings are starting to decline, and earnings growth in particular is starting to turn down, then we're going to see that valuations are going to become lower, or they're going to become stretched. And stock prices may turn lower. Now, we don't know where prices will end up, but if valuations are being getting way too high, we think that there's a much higher risk of the stock market dislocation, and that will be brought on by a recession. But we don't. At this stage, we don't know when that recession will happen.
But what is? What changes have you made to your funds pre-US-China trade war and now, because there is a constant negotiation between US and China? Have you rejigged your portfolio or have you made changes?
So we make incremental changes as we see valuation opportunities play out. And so we've been a little bit underweight, and it's become more underweight to US equities, where we think they're quite overvalued at the moment. And over probably since 2015 in our portfolios, we've been slowly decreasing our weight to US equities.
So that's much ahead of what the
well
US
ahead of time, because we could see that valuations are getting stretched over that time. And so small smaller underweight positions, and now it's quite underweight the US relative to global benchmarks. In terms of emerging markets, they've been, or the Koreas, India, other markets have been sold off quite heavily because sentiment due to the trade war has been quite negative. China, obviously, as well. Again, we're starting to position our portfolios towards those areas because we see opportunities that other investors aren't seeing at the moment from a valuation perspective.
So closer home to India, foreign investors have been constantly selling, and this is not uniquely India; it's also for the entire emerging markets. So, do you see foreign investors coming back to emerging markets or specifically India?
I think so. I think that many other investors that focus on growth much more than value, like we do. They're much more momentum driven, much more focused on where opportunities to grow cash flows are right now. Much more tactical, is I guess what I'm saying. Whereas we're going to be much more incremental and take advantage of them sucking liquidity out of the markets and seeing prices go down. We're going to take that as an opportunity. But I think as soon as they get some kind of view on the trade war or how growth prospects are going to play out, they'll certainly come back into those markets. They need more certainty. We focus on the underlying cash flows as opposed to macro developments.
So right now we are in an environment where geopolitical tensions have kind of had its impact on commodity, crude, which has been hovering around its record levels in the last few weeks, and currencies, dollar is very it's stronger, but emerging markets, Asian currencies are getting weaker in an environment as such where commodities are very expensive and currencies are depreciating. Do you make changes to your portfolio when you are investing?
Not necessarily, not because of the big macro issues that are out there, but we'll look at how those macro issues are affecting the underlying businesses and the underlying asset classes that we're investing in. Certainly from a currency perspective, we'll model currencies and how we think that they are playing out. But I think in terms of currency, US dollar is different compared to a lot of assets. Where I'm from, for example, in Australia, it's relative, probably around fair value. Maybe the Australian dollar is a little bit expensive, but certainly for other parts of the world. And Australia is similar to EM. It's probably a little bit expensive currencies there because they've fallen so much relative to the US dollar. But other areas, it's US dollar is reasonably expensive. And other currencies such as the yen even more expensive.
Yes.
And so we will make judgments based on the valuations that we see.
But how often do you kind of churn your portfolios?
We make incremental change. I'd say that it's not a quarterly. We will review our portfolios on a monthly basis and have big asset allocation reviews on a quarterly basis, but we're not making wholesale changes to our portfolio ever. We're not tactical investors where we're really switching around. We're focusing on bottom up, like fundamentals, and how we should be positioning portfolios from there.
You mentioned about valuations and US being very expensive at the moment. Which markets do you see where valuations are fair or cheap and earnings growth is, there are visible earning growths?
So I don't think that even in the bond market, there's not many cheap markets out there at the moment. The US we think is very expensive, but even emerging markets, UK, Japan, Korea, Germany, they're areas that we think that they're on a relative basis, valuations look attractive. But even then, from a historical perspective, they're not necessarily cheap. They're I guess there's no cheap, easy wins out there in this kind of market. And that's kind of one of the reasons that we think you need to be much more, have a much more unconstrained dynamic approach, because we think that there's opportunities, but they'll change over time. Certainly, if there's a big dislocation. At the moment in our multi-asset portfolios, we're probably holding more cash than we would generally, even though it's a low-yielding asset. We think it has optionality. So if there is some sort of fear come into the market and a sell-off, that we can redeploy that cash quite quickly.
Okay. So the US Federal Reserve have been consistently cutting rates. What do you think that has an impact on the emerging markets? Also, if you can throw some light on FIs, buying into India, if it impacts.
So I think that as we see the Fed continue to cut rates, that will be supportive to markets. It's whether they're doing this too late in the cycle, and that we're already starting to see a downturn. Also,
but worldwide, most central banks are into an easing mode.
That's right, and I think that obviously that will support markets, but at the same time we're seeing some leading indicators pointing towards a bit of a cyclical downturn.
Okay.
So again, we see that as an opportunity. Other financial institutions may well see that as an opportunity going forward. In terms of emerging markets themselves, I think we'll play a wait and see approach how supportive central bank intervention is over the next little while, and how that affects company earnings going forward.